Hi everybody, I am Brian, the Finance Ninja. So today, I'm going to be discussing Alibaba's earnings report. I will be discussing the report, my thoughts on it, and where I think the stock is headed. Um, I think you all know Alibaba. They are the giant in China. Um, they are just massive. They do everything. So, let's get started. So, as you can see here, just looking at today's stock market numbers, um, it's down 6.08%, down $13.36 at $206.54. Market cap of $577 billion. Of note, though, you'll notice that back in October 19th, they used to have a share price of $309.92. Today, it's at $206. So they are down 1/3 from their high. For a company this large to be down that huge, there's got to be a reason. And I think we all know what it is, but let's continue. So let's just look at just a news article about their earnings report. It says Alibaba earnings miss. Revenue tops for China e-commerce giant. So let's look in a little bit more detail. So they reported an adjusted earnings of $1.58 a share on revenue of 28.6 billion US dollars. Expected was $1.79 on revenue of $27.8 billion. So they beat on revenues and they missed on earnings. These are adjusted earnings. According to FactSet, see here. Oh my God, the revenue jumped 64%. For a company that's huge, to have revenue jumping 64%, that's astronomical. My God. And the stock tanked at 6.2%. Let's continue. Alright, so the company said the 1 billion active customers included 240 million customers outside China, 811 million inside China. Let's see, an increase of 85 million from a year ago. Mobile active users increased 79 million. Looks good here. Always good to have growth. Let's see, okay, so this month they realized the $2.8 billion antitrust fine. So that's a huge fine. That's going to skew this month or this quarter's numbers. So we're going to take note of that. So I'm going to actually focus more on the year-over-year numbers as opposed to the quarter-over-quarter numbers due to this fine because it's a huge fine and it's going to skew the numbers quite significantly. As noted in this article, China suspended the spin-off of Ant Group, which is unfortunate. I wish China would just leave Alibaba alone and let them take over the world. Baba to the moon. It's my saying, but China's going to do what China's going to do. So analysts expected pressure on profits due to higher spending on growth initiatives. Spending on growth initiatives. That is good. I like it when companies spend money on growth. That's what growth companies are supposed to do, and this will pay dividends in the future. This is great. Let's see. China's list of big internet companies. It just gives a description of Alibaba, fast-growing cloud company, digital media, entertainment, retail operations, and a grocery business. That all sounds fine. Continue. All right, now for the meat. The fun stuff. So, revenue, 28.6 billion US dollars, an increase of 40% year over year. Oh, this wasn't mentioned. Okay, so excluding the consolidation of SunArt, our revenue would have grown 40% year over year to $24.4 billion. So that's a big difference. I wish that news article would have mentioned that. But still, regardless, for a company for a $577 billion company to grow revenues 40% year over year is huge. And Alibaba was able to do it consistently, so props to them. Annual active customers, an increase of 32 million. That's good. Mobile MAUs, increase of 23 million. That is good as well. Let's see, they noted a loss from operations, again, due to the fine, so we're just going to ignore that. See, excluding that fine, the income from operations would have been $1.6 billion. An increase of 48% year over year. Nearly 50%. Boy, oh boy, oh boy. Adjusted EBITDA, let's see, increased 18% year over year. Let's see here. What else do we got? 18%. So net cash provided by operating activities was 3.7 billion US dollars. This company's huge. Let's move on. So this is the part that I concentrate on the most in any cloud computing company, in this case Alibaba, but also in the case of Microsoft as well as AWS. It's their cloud computing division. So this is where I really focus and hone in, because at least in those other companies, that's their growth vector. Not so much in the case of Alibaba, but it is huge for them, and it will be huge going forward. The thing about Alibaba and their cloud computing division is they're the biggest cloud computing provider in China. There is no real competitor. Well, the thing is, Microsoft, AWS, Google, and all of them, they're all based in America, the United States. So Alibaba, being based in China, has home field advantage for Chinese retailers. Chinese e-commerce companies and any Chinese business that wants to be on the cloud, they're likely going to choose Alibaba first, because home field advantage. Likewise, companies in America are going to choose an American company first. People in America choose American, people in China are going to choose Chinese. So due to that, that gives them a significant leverage, and it's going to pay them dividends in the future. So let's move into it. Their cloud computing revenue grew 50% year over year in the fiscal year. Those are great numbers. No problem with that. That's actually more than the industry average, and it's more than AWS, and it matches Microsoft. Microsoft's at 50%, AWS I think is at 32%. So that means that Alibaba's gaining market share. In the March 2021 quarter, the revenue grew 37% year over year. 37, that's low. Let's see. The slower revenue growth during the quarter was primarily due to revenue decline from a top cloud customer in the internet industry. I hope it was a big customer. That's all I'll say about that one. I'm going to pay attention to them in the next quarter, and I hope and expect that they will return to their previous glory. I want them to have at least 50% growth year over year. Because at their size, they're, I think, tied for number 3 in the cloud computing industry. So they need growth. They need to grow faster than number 1 and number 2 if they want any chance of being considered in the top tier echelon. Because the top tier echelon is Amazon. Far below them is Microsoft. Far below Microsoft is basically everybody else. So right now, Alibaba is in the everybody else category. I want them to be in the top 3, like near the top 2. So that way they're in the conversation at least. When somebody says, "Hey, let's go to the cloud. Who are we going to pick? 1, 2, or 3? Amazon, Microsoft, or Alibaba?" Because right now it's just Amazon or Microsoft. So they need to work on this and get that number up. Let's see, it says going forward, we believe that our cloud computing revenue will be further diversified across customers and industries. I think that's trying to shine light on the fact that they lost that one big customer. They're not saying who the customer is. Yeah, I don't see who the customer is, but yeah, I think that's just trying to say, you know what? Okay, yeah, let's try to make it sound good. You know, this one big loss, make it sound good. So let's go. Revenue and adjusted EBITDA summary. Let's see, everything. Wow, this is huge. My lord. All right, so core commerce grew 42% year over year. Cloud computing 50%. So these are the fiscal year end, yeah, the year ended summaries. Digital media and entertainment grew 7%. They need to work on that one. Innovation initiatives and others up 8% year over year. They also need to work on that one. Overall, up 41% year over year. That is massive. Okay, for the numbers themselves, as you mentioned, the revenue 64%. It just up 64%. I'm only concentrating on the year-over-year growth right now. But anyway, the revenue is at 187,000 or 187. I think that's billion RMB. Just EBITDA up 18%, 14%. Non-GAAP net income's up 18%. Keep in mind, those are the numbers that were affected by the fine. So let's not look at those. Let's look at the year-over-year numbers. Although keep in mind, the year-over-year numbers is also affected by the fine, but it's not going to be as affected by the fine. But next year will look much better because the fine will be not included next year. So as you can see, the EBITDA 25%, 24%, and then non-GAAP net income of 30% year over year. For the year. So those are fantastic numbers, again, for a large cap company. Basically, China's biggest company. Those are huge growth numbers. So this company is a growth beast. Free cash flow grew 84%. Or let's go over year over year. It grew 32% year over year. Another beast number. As we all know, Alibaba is huge. So one of the sort of interesting things that a lot of people don't really know about Alibaba is there are new categories. In this case, new retail. Because they're just trying to adjust the way that consumers can get their items from Alibaba. And I'll just give an example. Let's say you're cooking dinner and you find out that you're missing an ingredient. You can place the order and have it delivered within 30 minutes. It's not bad. 30 minutes isn't bad. We have similar services in America, obviously. Several services, DoorDash and all of them. So it's not necessarily a new thing. I'm not sure if it's new to China, but it's not a particularly new concept in general. So digging more into the numbers, these are huge growth numbers. Let's see, China Commerce Retail up 42%, China Commerce 15%. I'm just looking at the number tabs on the right. Well, consumer. Okay, so total core commerce 42%, total revenues up 41%. We already went over that. Let's see, anything of note. Cloud computing revenue up 88%. Oh no, EBITDA. Let me take that back. Cloud computing EBITDA up 88%. That's huge. Cloud computing is profitable. Yep, cloud computing is profitable now for Alibaba. So yes, what do we have here? Cloud computing went from a loss last year to a nice profit this year. And it's only going to get larger. As you can see, the revenue just jumped astronomically as well. Yep, looks good there. Oh boy, Alibaba has $72.3 billion US dollars in cash. That's a lot of money. Let's see, free cash flow. We went over that before. Okay. All right, so the estimates going in for this year, we're just going to give it like a summary, essentially, of what analysts think are going to happen this year, as well as next year. So what the analysts think is that sales growth this year is going to clock in at 40.5%. So that is a massive number for a large cap company. The earnings per share is going to grow from $8.17 to $10.26. Nice growth there. And in 2022, they're expecting 30.7% revenue growth. Also a huge number. Oh, and they're expecting revenue next year, 2022, of 144 billion US dollars. So the thing here is that Alibaba, given their growth rates that I mentioned, 40.5% only has a forward PE of 19.38. 40% growth, 19 forward PE. It's like, what? Is this the cheapest stock in the world? Could be. It could be. Price per sales is 6.06. But yes, that forward PE is absolutely just minuscule compared to how fast they are growing. They are growing just by leaps and bounds. So there is a reason, though, that their forward PE is this low. The reason, we all know, it's due to China. China gets their hands into things. They sort of tinker with things. They do things to the benefit of the Chinese government, and not so much the Chinese firms under them, or the Chinese companies under them. As an example, they're tinkering with Ant Group in that situation. They're not letting them spin off Ant Group for just crazy reasons. It's unfortunate, but that's why Alibaba is trading at a discount. So there is risk to the stock, and that risk is priced in. If you're willing to take on the risk, I think this is a really good buy. If China gets a little nicer towards these companies, for example, Alibaba already went through their antitrust ordeal, so that's out of the way, gone. So as China sort of, I hope, sort of gets a little more lenient on Alibaba, I definitely expect that forward PE to increase, because a 19 PE, again, 40% growth, 19 PE, it's insane. No U.S. company would be at their PE would be triple that amount right now. So I think this company is worth currently a third, or it's worth triple what's currently priced at, all due to China's shenanigans. Again, their only sore spot for me was their cloud division. So the Alibaba Cloud looks like they have estimated 6% market share, Google Cloud 7%, and then you can see the two big guys, Microsoft Azure at 20% and AWS at 32%. So as I mentioned earlier, I just want Alibaba Cloud to grow faster than Microsoft and AWS and Google and the others. I want them to be considered the number 3. That'll do it for today's video. Make sure you smash that like button, subscribe to the channel, and I will see you in the next one.